for the documents you've given us. We will take those into consideration. We will now have a chance for committee members to ask a few questions if they have any, and then we will hear our final panel, which will be the consumer perspective on these longer loans. Mr. DeBobney.
I have a question for Mr. Gutierrez to start off. In the new company that you're founding, obviously it's a slightly different business model than your previous one. What kind of obstacle do you obviously see, though, with the finders? Do you anticipate that these regulations will make it obviously harder or easier as we go forward to include them into this product? And what type of safeguards do you anticipate we'll need to make sure that obviously the software and the product you're offering is very legitimate and obviously, as shown with your previous company, is very successful? How we get it to the masses, how you expand the ability to get that to people that be able to get those kind of loans, improve their credit, have an amount that's more reasonable for their needs, and have it in an installment period, all seems good. But in terms of the finder situation, how are you going to make sure that the people that are now going to be carrying out the product, almost like a franchisee, continue to keep the standards that you, I think, painstakingly put into your previous company?
Thank you very much, Assembly Member. I think you make a good point. In my previous company, when I left, it was about 100 stores. I think now they're 150. Californians deserve more than 150 locations to get a good loan, right? And there's many more Californians than one company can serve. So the question is, how do you proliferate? Once you design a good loan, how do you proliferate that? The new company I'm doing, as you indicated, has created the back end and the systems so we can partner with someone else who has the store, but it's all predicated on everything has to pass our underwriting. So even though someone on the front end is just typing in information, about someone in front of them into the system, we still review all of that information, and we are the lender that has to take the risk, and it has to comply with all the pilot program requirements about ability to repay. And if the CFPB proposed rules are passed as they are, we would have to then comply with those rules as well. So I think this is an example of, so I think two things. One, there should be a lot more finders, and I don't think there's a lot of concerns around safeguards because it all has to pass through the CFPB, because since we're the lender, we would have to comply with the CFPB rules and have to do ability to repay and be able to document that. So all the loans would have to pass through that kind of rigor. The real question is, 150 stores from the old company is not enough to serve the need. And then I think the bigger issue is this is now national regulations. So, California, we are the largest state, but there are a lot of unbanked people in the country. And we need to think of more innovative models when the banks are not going to be there to provide anything, of how do we partner to get loans out there to the people who need them.
Your previous company obviously had the technology was a big part of the underwriting, and that was obviously kind of the key to it, but it was a brick and mortar storefront. Could you envision that this new endeavor could provide this technology to a number of the other brick and mortar locations and maybe even other financial institutions, and you could see that you would be able to help bridge the gap between not being able to underwrite for a reasonable cost that is now prohibitive and wouldn't be able to be included in a business model? Could you see your software and your technology being that bridge?
Absolutely. I'll give you two examples. So we're going to be announcing very soon a partnership with a bank. So surprise, surprise, bank cannot approve these customers, cannot make these loans. So they're going to use our system to offer, our underwriting will be used in their branches to offer these loans in 680 locations.
What bank was that, I'm sorry?
Can't announce it yet.
I'm sorry,
not soon, but we're excited about it. But in addition to that, I would say it's a forward-thinking one amongst the forward-thinking banks there are. The other one is we are in partnership now in California with Check Center, which operates 20 check cashing and payday locations in California, where last month alone we had over 1,000 applications under the pilot program loans. So that's an example of us partnering with a check casher and payday lender to offer pilot program loans in this new wave of innovation.
Great. Mr. Chair, may I ask one question of Chairwoman Trepper before I have to step out? Thank you.
Thank you.
I would like to thank the chair for including us in this today. I really appreciate this. It's been very helpful, and I thank you for your leadership, your staff, and the vice chair's leadership on this as well.
Very pleased you're here because both houses will obviously have to work together on this and many other issues.
We're going to be spending a lot of time together, and I think with a lot of people in this room, and I think we're going to get a lot done, hopefully. But Chairwoman Treppa, I think earlier we heard from a consumer advocate group that I think had obviously some valid points that they made, and obviously are very concerned with consumer protection. I think we appreciate their efforts in that regard. But they kind of portrayed tribal lending in somewhat of a bad light, for lack of a better word. They made it seem like basically you give over your tribe name, investor X comes in, they front the money, they're really running the operation, they're taking 99% of the profits, the tribe gets a 1% kind of just thank you for pretending to be the front man. It seems like you're portraying a very different point of view. Can you just quickly elaborate? I know we're short on time and I don't want to drag this out, but can you elaborate, who runs your operations? Where do those profits go? How much of the profits stay in the tribe? And what type of benefit to your community are these profits leading to? And can you give us some specific examples of things within your community that are being paid for by the profits from this endeavor?
Thank you for giving me the opportunity to answer that. We own and operate 100% of the business. It is ours. As a matter of fact, we have started off with a single lending enterprise and now have 3. We have a call center that we operate and employ 150 people. We have a lead generation marketing company that also employs several people, and we do all of that in-house with our tribal members and some other contracted members or outside employees. 100% of the profits go to the betterment of our tribal community as well as the local community. We give back a lot to the community at large. Scholarships, our kids are now being able to go to college where in the past they've never been able to afford it. We have health care opportunities for folks that are lacking that ability to pay for. We provide job incentive programs and assistance when you are unemployed. We suffer from 70% unemployment in our community. And as I'd mentioned, our tribe's philosophy is to give tribal members the ability to be self-sufficient.
And your loans are underwritten at this point?
Absolutely.
And is it possible, could someone using the same name and identification information, could they get multiple loans from you at one point, or is it
No.
one at a time as well?
No.
And do you do any reporting at this period to credit bureaus?
Pardon me?
Do you report to any of the credit bureaus?
No, we do
Okay,
not.
thank you.
But may I comment on the statement that was made earlier? It is our understanding, although I'm not an attorney, this act is not a law of general applicability. It clearly defines tribes as states, and therefore it allows us to co-regulate with the CFPB. I also share the commissioner's position that this is looking to preempt the tribe's authority as well as perhaps another sovereign state.
Duly noted. Thank you.
Thank you.
Thank you, Mr. Chair.
Thank you, Mr. Bobney. Thank you, Chairwoman. Moving now to Vice Chair Videk.
Thank you. Mr. Reish, you talked about 8, 9, 10-year-old cars. I'm guessing you're really not trying to be in the car business. Is that?
No,
you-
Mr. Chairman, Senator, as a matter of fact, we will do everything possible not to have to get a car back.
Right.
Under California law, there is no windfall in the event that a car is brought back to us. Basically, that car is sold at an arm's length commercially reasonable auction, and we are obliged under the UCC to return any excess proceeds over the amount earned back to the borrower. So there's no windfall there. We will do everything we possibly can not to have to repossess or get a car back, and even in terms of settling it for a percentage of its value.
Thank you.
And with that, I would like to thank and excuse this panel, appreciate the insights, and call up our final panel of the day. That panel, Pauline Gonzalez, Executive Director of the California Reinvestment Coalition, Suzanne Martindale, Staff Attorney with Consumers Union, and Paul Leonard, Director of the California Office Center for Responsible Lending. Okay, our ground rules were to give each perspective on each of these panels 25 minutes. So even though this is a smaller panel, you will get the full 25 minutes. So if you can divide 25 by 3, you know about how much time you have. We will begin with Ms. Gonzalez.
Good afternoon, Mr. Chairman. Thank you for the opportunity to share CRC's perspective on the impact of long-term loans on low-income families in California and the Consumer Financial Protection Bureau's new proposal for payday, card title, and other similar loans. My name is Paulina Gonzalez, and I am the Executive Director of the California Reinvestment Coalition. We are a statewide coalition of over 300 community-based organizations working in low and moderate income communities and communities of color. Earlier, we were called well-heeled activists who don't understand the needs of consumers who might need a payday loan. I'd like to hear the industry representative's background who made the comment, because I'm about to tell you mine. On a personal level, I understand firsthand the desperation of trying to make ends meet. I understand what it's like for a family to not have enough income every month to pay the rent, not to have enough money to pay the bills, keep the lights on, or put gas in the car to get to work every day. I understand the desperation that might make a family walk into a payday store and take out a loan hoping to obtain some immediate relief to the uncertainty of poverty. I understand this because I grew up in Montebello, South Montebello, California, a working-class community just outside of Los Angeles, as the daughter of immigrant parents from Mexico who struggled to put food on the table and keep a roof over our heads. We suffered through the humiliation and uncertainty of being rejected by traditional sources of credit on more than one occasion. But like many in our communities, for my family, it wasn't a need for credit, it was a need for more income to make ends meet that we badly needed in order to keep a roof over our heads and the lights on at our home. In those days, there was no such thing as payday loans in order to help meet the gap between income and expenses. We had to tighten our belts, borrow from family and friends, recycle cans, we did whatever it took. It wasn't easy. What I'm glad we didn't do, what we didn't have the option to do, is end up in a debt trap that left us worse off than when we started, with our credit in shambles that left us deeper in an uncontrollable cycle of debt that could end with us possibly being homeless, and at the end of the day, that would have left us with a bigger gap between our income and our expenses than when we started. What I'm glad we didn't have the option to do is to walk into a payday store. Because what we and so many Californian families need is income, and what we definitely do not need are predatory loans. What my family needed back when I was a kid and what Californians need now is a living wage and better financial security in general. And what Californians need is protection from predatory loan products. That is why what the CFPB is proposing to do, the rules it is undertaking this year to rein in payday and other forms of predatory lending are essential to the financial well-being of low-income families in California. Because although the payday, installment, and auto title industries would like to sell us their products as a service to working-class families who need to make ends meet and keep a roof over their heads, these products are far from that. These products, as currently designed, are made to profit off the fact that people who use them can't afford them and have to take out repeated loans in order to pay them back. These products are not a credit service to the needy. They are a largely unregulated product that leaves families worse off than when they started. I, like many of you, believe that income and access to good forms of credit is critical to a household's financial health and capacity to achieve milestone goals. The harm in payday and predatory installment loans is that they are unaffordable from the get-go. They are structured this way. That is how these lenders make their profits. There are those that would argue that credit, any form of credit, 400% interest rate or not, is needed by our communities. That it is needed by families like the one I grew up in order to serve as a safety net during times of economic need and dire straits. In the time I have left, I'd like to share a story from a consumer from Los Angeles who fell prey to a high-cost installment loan, because perhaps her story will shed further light on why we need strong CFPB rules. Joanne Taylor lives in South Central Los Angeles. She is a food service worker with Alley Unified School District, where she has worked for the past 15 years. Last year, she received an email indicating that she was, quote, pre-approved for a $3,000 loan with Rise, one of the lenders who's here today. Since Joanne only works when school is in session, she often has periods throughout the year when she has trouble making ends meet. She also has a daughter who is a senior in high school and who is getting ready to start college at Cal State University. Upon receiving Rise's solicitation, she thought it would be helpful to have some extra money to help with her expenses, especially to be able to give her daughter a nice senior year, since senior year festivities can be expensive. So she decided to take the $3,000 loan. She told the lender that she could afford to pay $289 a month. Instead, the lender began debiting $289 from her checking account every 10 days, over $600 a month. This was absolutely unaffordable and unsustainable for Joanne, and she quickly found herself falling behind on bills and rent. Because Rise was automatically deducting $289 from her bank account, she incurred numerous overdraft fees. She estimates that she paid at least $245 during this period on overdraft fees alone. In December 2014, she defaulted on the loan after paying almost $4,500 to the lender for her original $3,000 loan. She was forced to close her bank account so that the lender could no longer access her account. Rise claims that Joanne still has an outstanding debt of $3,000 on her loan, though Joanne doesn't understand how they are allowed to charge so much more than she borrowed in the first place, especially since she had already repaid the loan plus $1,500. Worst of all, she fell a couple of months behind on rent and was evicted from her apartment. Now, Joanne and her youngest daughter are homeless. They are staying with her older daughter, and Joanne is currently trying to find an affordable place to live. This consumer story, which is one of many we hear every month from our members, is the reason that CRC believes that the CFPB's proposed rules, which are broad and cover predatory loans beyond the small dollar payday loans and cover installment and auto title lenders, set an important floor for California consumers. At the same time, we believe that the proposed rules do not go far enough and need to be strengthened as the CFPB goes through its rulemaking process this year. The CFPB is considering rules for longer-term loans that would allow lenders to choose between underwriting, taking into account both income and expenses, as well as borrowing history, or an alternative debt trap protection requirement where the periodic payment does not exceed 5% of the borrower's expected gross income for the corresponding pay period. We strongly oppose this alternative and believe that meaningful underwriting should be a requirement, not an option, and I underscore meaningful underwriting. In addition, the CFPB is considering permitting certain loans not exceeding $1,000 to be made on terms similar to those permitted for the National Credit Union Administration sanctioned loans, which include an application fee reflecting costs of no more than $20 per loan and an APR not exceeding 28%. While we believe that this would be a vast improvement to currently unregulated installment loans, we encourage requiring underwriting that takes into account income and expenses, as well as borrowing history. In short, CRC believes that underwriting based on income and expenses, as well as borrowing history, should be required at the onset of any long-term installment loan and before any subsequent loans are given or refinancing the loan. This lack of adequate underwriting has been the basis of the unsustainable debt trap currently suffered by borrowers and the business model by which the industry has operated and profited. If underwriting only takes into account income and fails to take into account expenses, it will fail to adequately determine whether the loan is ultimately affordable to the borrower or whether it will spiral the borrower into unsustainable debt that will leave the borrower in a situation in which he or she, like Joanne Taylor, ends up in a situation worse off than when she started. We believe that a loan should enable a family to make ends meet, not make them have to choose between keeping the lights on or borrowing another loan. The supposed purpose of these loans is to minimize the shock of an expense to a person's wallet. Without proper and meaningful underwriting, these loans at best push the entire shock forward a short while. At worst, they intensify the shock until it is not survivable. Thank you.
Thank you. We move on now to Suzanne Martindale.
Chair and members, Suzanne Martindale with Consumers Union. Greatly appreciate the chance to testify today about the Bureau's proposal to set some federal rules of the road for various types of high-cost credit, including installment loans, which is what we're here to talk about today. A little bit about my organization. Consumers Union is the advocacy arm of Consumer Reports. We've been around since 1936, and we are an independent nonprofit organization that seeks to help consumers empower themselves through our research and product testing and advice, but we also seek to increase fairness in the marketplace through policy reform, which is precisely why we're here today. Our work in the area of financial services focuses on the major decisions that affect your wallet, how best to manage the money you have, and how or whether to borrow money that you don't have. Given the enormous power and political access that the financial services industry enjoys today, I think it's more important than ever for all of us to work together to prevent abusive lending practices that drain precious dollars and cents from those who can least afford to do without them. My colleague from the California Reinvestment Coalition shared a heartbreaking example of what happens when some unscrupulous lenders don't underwrite and essentially engage in what I would consider legalized theft. This is draining precious resources that someone cannot afford to lose, which is precisely why we are so concerned about underwriting standards. And this point about anecdotes, these anecdotes, it's not necessarily, it's not data, but we have to remember that behind the data, if it's nationally representative, it's comprehensive and whatnot, there are human faces behind that data. And that's why we care, and that's why we bring consumer stories with us to events like this, because we want to remember the human cost of someone being worse off than they were when they started because they took out a loan that they simply could not afford and never should have gotten to begin with. This is why we believe that the CFPB proposal is an important first step in setting national standards for high-cost lending. By focusing on the basic principles that lenders should make loans that consumers can actually reasonably pay back at the outset and over time, the proposal supports lenders that are responsible and marginalizes those that are not. That's what we want to see. We want to see rules of the road that protect consumers and that support and give a competitive advantage to businesses that are providing affordable and safe loans to consumers. However, we are concerned that the proposal contains this kind of menu of options that could leave gaps in protections for consumers. We would prefer an across-the-board requirement that lenders assess a borrower's ability to repay. For these reasons, we believe that states such as California should not wait for the CFPB to protect consumers. They can and they must play an active role on the front lines of consumer protection. We're also very heartened to hear that the commissioner of the DBO, feels similarly that we should not wait for the federal government to act in order to start acting now for our residents. Now, longer-term loans can pose many of the same problems as those discussed on the previous panels. While a balloon payment on a short-term loan may be the most kind of obvious or extreme example of a high-cost loan product, we need to make no mistakes here. Consumers can also get stuck in cycles of debt from risky longer-term loans with no meaningful underwriting. In addition to charging high interest rates, some installment lenders may keep consumers in debt through refinancing over and over again, extending the principal owed and pushing back the light at the end of the tunnel for consumers in financial distress. For these reasons, we are concerned that the CFPB proposal would permit alternatives to ability to repay, and I simply echo the points that were already made by my colleague to my left. Still, it's important to remember that the CFPB proposal is a floor. It's a start of the conversation. It's not a ceiling. It in no way mitigates the authority and responsibility of our state and states around the country to do more to protect residents. Here in California, the legislature has shown interest in encouraging safer, longer-term loans. Several of us in this room have worked on the recent pilot programs for safer small-dollar loans enacted by SB 1146 in 2010 and then later replaced by SB 318, the current pilot, a few years ago. These pilots have set minimum requirements for licensees under the CFLL seeking to offer installment loans under $2,500. Notably, the current pilot includes interest rate and fee caps, limits on refinancing, and an ability to repay requirement. It's different from the CFPBs, but we think that the fact that in principle there is an across-the-board requirement sets an important and powerful precedent here in this state. The pilot's not perfect. We continue to have concerns that some of the loans may end up being too expensive. However, we support the substantive principles contained in the pilot and look forward to seeing the resulting data that the DBO will be preparing shortly. I'm really looking forward to see those reports. The pilot, we believe, represents the start of a longer conversation here in the state about how best to protect consumers and support responsible businesses offering longer-term loans. Just to take a step back here, we need to remember that, this committee has its jurisdiction, but I think the fact that so many people are running to and have seemingly nowhere else to turn but to go to these types of products, that is symptomatic of a larger problem. And I think that we still need to keep that in mind, even given the limited jurisdiction of this committee. I think that if consumers in California in large numbers cannot make ends meet, that is our collective failure. If they can only access high-cost credit instead of more affordable, safe options, that is also a result of our collective failure to act. This legislative body must take a step back and think bigger. I think we need a bolder vision for how to reduce working families' financial insecurity and how to promote true economic justice in this state. So I look forward to continuing the conversation with you all. Thank you.
Thank you, Ms. Martindale. Mr. Leonard.
Yes, thank you, Mr. Chair, and the resilient members who have managed to stick it out to the end. I will try to keep my comments brief because I know I stand between you and all of our chance to rumble on to the bar for a drink after this long hearing.
Don't forget there is public comment.
Oh, yes. I want to echo, stray from any prepared remarks, and echo the concerns fundamentally about underwriting and the importance of underwriting, particularly for these long-term loans. The CFPB has this sort of Chinese menu option of an option A or an option B, real meaningful verified income and major financial obligation, ability to repay underwriting in column A, two choices in column B, either a 5% of income limit on the amount on the payment, or the NCUA model. Of the two, if there has to be an alternative, we prefer the NCUA approach, and that is primarily because we don't think that any model that provides an across-the-board income-only measure for underwriting addresses the enormous variations that you're going to find in individual borrowers' expense situation and whether they will actually be able to repay a loan or not, regardless of how small that share is or how large it is. And it's going to vary from a senior family to a low-income family with children. Their expense structures are going to be very different. So having universal across-the-board underwriting seems critically important. In that vein, I think it's also important to think about the scope that CFPB covers. CFPB actually, in this arena, has a very narrow scope, which it covers loans above 36% interest rates, and that only automatically it gives the lender an ability to get into a borrower's account, either through holding a paper check or through electronic access at the outset of the loan. We think that that scope should be expanded to include unsecured loans, longer-term installment loans. If we're going to have an underwriting requirement, there doesn't seem to be any reason why it shouldn't apply to unsecured loans as well, as many of the loans that we heard about from some of the providers claim to be, although I think some of those providers actually take electronic access and so don't meet the CFPB's definition of being truly unsecured and would be covered by the rules. The other areas of scope that I think it's important just to hear about today and that we think deserve to be considered in the rules, either short-term or long-term, have to do with credit cards, personal property, and pawn in certain circumstances. The bulk of our concern for each of those areas is that these products will be used to create mechanisms to evade the intent of the short-term or the long-term restrictions that are included in the bill. So creating a payday loan product through a repeat usage of a credit card, or through personal property, which is more similar to and provides coercive leverage to make sure that borrowers repay, similar to a car title loan. We think it's really important that the protections that are envisioned are provided more broadly, particularly with respect to underwriting. I think that the importance that we haven't mentioned today of back-end protections and that the CFPB is going to collect and hold large amounts of data on the performance of these loans is critically important for the purposes of enforcement. And together, I want to bring this back to what's happening in the longer-term installment loan market here in California today. There are a number of lenders that are currently operating in the above $2,500 space. It's a space that has no interest rate regulations whatsoever, and so these lenders can charge whatever the market will bear, and they do. We didn't hear that from the representatives of the lenders. We heard precious little about the terms of the loans, what the interest rates were, what the payments are. And we heard little about the performance of these loans. And I wanted to just make sure that before we ended the hearing that we understand what's happening in these markets today. I went to the web. Check and Go has become the largest lender making loans between $2,500 and $5,000 under the California Finance Lenders Law. And the loan that they sort of advertise as the typical loan is a $3,000 loan. It's an online loan that they offer. It has an annual percentage rate of around 220%, monthly payments of $623.88, which means that after just 5 months, the lender will have recovered more than the original principal balance of the loan. And after 6 months of payments, after the sixth payment, they will have made $743 in proceeds above and beyond the $3,000 of original capital. What that means is that a lot of these loans, and looking at the DBO's own data and reports from the lenders about this, is that what we see is very high level of charge-off rates. Why it's important to have back-end monitoring, and why it's important to have better upfront underwriting is because these loans work in a way that's called a sweatbox model.
5 minutes left.
Sure. That you can actually you don't actually have to recover. You can actually sustain significant levels of defaults and charge-offs and still be profitable. We looked at recent evidence from a number of the major lenders in this arena here in California. Rise Credit was one of them. They reported charge-off rates to the DBO of more than 100% of their average monthly balance of loans in 2014. Cash Call, Net Credit, also a Check and Go, all reported more than 30% charge-off rates. We think that level of charge-off and default is an indication that upfront underwriting is not working. And moreover, I would add, in listening to the earlier testimony, that if the upfront underwriting is as effective as they claim it to be, I would raise the question about why the lenders need to have access to the car title or need to have access to the borrower's account through a paper check or through electronic access. Certainly, the account access is not considered formally collateral per se, but as I discussed earlier, it does provide an enormous amount of access and first-in-line repayment risk, which allows lenders to reduce their underwriting standards. And I think we see the same thing here in the larger loan amount market. I want to stop there and entertain any questions. We have a lot of technical comments which we've included in our testimony, but would be happy to answer any questions you have going forward.
Okay, thank you. Senator Vidak, any questions? I've got the example, Joanne, the case study you used, you said that she had, I guess, said to you that she had been promised that no payment would be due for 30 days and that her bank account was debited in 10 days. Is that accurate?
She told the lender that she could afford $289 a month, and she was then debited every 10 days, $289.
Did the lender agree on the 30 days, or?
Well, that's what so again, it goes back to underwriting and what somebody can afford, and so there was no underwriting done. And so she came away thinking that the lender understood that's what she could afford, and that is not what happened.
Okay, so it's not that any agreement was violated?
Not from what I understand, but that's what she came away understanding, and that's what she communicated to the lender. So it goes back to underwriting and what somebody can afford, and that's what she communicated she could afford.
Would the CFPB regulations, if they had been adopted as they're proposed now, have protected her or just denied her access to the credit at all?
If underwriting is required, it could potentially have caught the fact that she could not afford the loan that was given to her by the lender at that time, yes. But if the lender has an option to not do the underwriting, it could potentially not catch this type of lending. So that's why we're pushing and that the underwriting be a requirement for lenders, not an option.
Okay. All right. At this point, I have no further questions for this panel. This is where members of the public have an opportunity up to 1 minute each to testify and support your minute of oral testimony with as much written documentation as you want to provide the committee either today or in the future. So I'd ask people who come forward if you wish to testify. We'll fill up the 5 seats here and then have a line, unless nobody wants to testify, in which case we all go home. No, don't want to chill that. Anybody who wants to testify, please come forward. Members of the public, not anybody who is on a panel. I see no one coming forward. Okay, in that case, I want to thank particularly my colleague, my vice chair, Senator Vidak, for being here for the entire hearing. Appreciate that. Would like to thank the other senators and Assemblymember DeBobney, who was here for part of the hearing. For any of you who want to get further information on the written documentation that was sent to the committee or given to the committee, or have an archived copy of this hearing if you want to watch the whole thing again because it's so interesting. The Senate Banking and Financial Institutions Committee has a web page that will have all of this information plus a copy of the televised hearing. In coming days, committee staff will prepare a final report of the hearing, which summarizes all the oral witness testimony we heard today and includes written testimonies submitted by any witnesses. If anyone has any questions, please don't hesitate to contact my office or the committee office. With that, I just want to really thank you all. It was a very informative hearing, and we'll go forward. With that, this hearing is adjourned.